Hi everyone, this is Umar with you. This is part of our option learning tutorial where we mention various strategies and adjustment for the benefit of our subscribers. In today's video, we will discuss one more adjustment for Ironfly. We have posted a video on how to make adjustment to Ironfly. You can check the link above if you want to know about the adjustment. Ironfly is one of the most popular strategies among retail traders due to its ability or built-in stop-loss system. It protects you from any major adverse move in the underlying, right? But it also has some limitation. Usually when it touches the break-even point, we had no other option other than to square off the position or book loss. In our previous Ironfly adjustment, what we did is we added one more Ironfly to the already existing Ironfly and thereby extending the range of the strategy by another 200 to 300 points. And even after doing the adjustment, it had the same limitation and we could end in a loss. But at the same time, the margin is also going to increase since you already had an Ironfly plus you are adding one more Ironfly which is going to dent your margin, but still you are going to have the same effect. So we thought of altering the adjustment so that we are exposed to unlimited profit if the markets move aggressively. We make a profit if the markets doesn't move, and we come out with a small loss if it moves in the opposite directions once we make the adjustment. And what this accomplishes is that with the same amount of margin money that is required to adjust in our previous video, we can make a good amount of money if the market makes aggressive move. This was not possible in our previous adjustment. Even after you made the adjustment, we could end up in loss. It is going to be little tricky to do this adjustment, so make sure you watch the video till the end so that you don't miss any information. So what I am going to do is, first I am going to simulate the strategy. For the purpose of simulation, what we will do is we will go to the month of March. March is one such month where it was very volatile, but market never moved anywhere. So we will take the month of March. At the starting of the March, Nifty spot was around 14,704. So what we are going to do is we are going to deploy a simple Ironfly, and what I am doing is I am selling 14,700 call and put at the same expiration. And how much is the margin? Call premium is around 418 and put premium is around 380. So let's say around 900 points, right? 800 points. So what we will do is we will go below 800 points. So I am going to buy 15,500 call for the protection of this 14,700, and on the downside I'll buy 14,000 put one lot. So what I've done here is 14,700 call and put I have sold. Then on the upside 15,500 call I have bought, and on the downside I have sold 14,000 put. So this is going to be a Ironfly, right? We don't have to see at this. We don't have to apply big logic. Just for the just to explain you, I'm just putting a raw Ironfly. So we'll see what is going to happen. So the thing is, the thumb rule is whenever this break-even point is breached, we are going to make an adjustment, right? So how much is our break-even point? On the downside 14,165 is our break-even point, and on the upside 15,235 is our break-even point. So let's see Hopefully March was one month where market like shot up, came down, and it was everywhere. So we intentionally selected this month for simulation. Till March 9th, it is has not breached our break-even point. And some people say this paper trading is possible, live trade it is not possible. I don't know. I'm just telling you example. You have to develop it from it, right? I cannot explain from A to Z. Okay. On 10th of March, what it has done is it is going to breach our break-even point, and the total loss is around 2,820. Okay, since our break-even point has breached, now what I am going to do is, since the market has come from 14,700 to 15,200 levels, what I am going to do is I am going to go to 15,200 strike. I am going to buy one lot of 15,200 call, and I am going to sell one lot of 15,200 put. So this is called synthetic future. We are trying to cover up the losses, or we are going to adjust the position using synthetic future. So I am going to explain you what is synthetic future. So what I have done here is 15,200 call I have bought and 15,200 put I have sold, and simultaneously I have bought 15,150. Since futures are high risk strategy, in case the market moves down, to protect our downside, what I have done is I have bought 15,150 put. So once we do it, it becomes like this. Now this if the market is trending in this zone, we are going to make a loss, right? But the losses is going to be minimal. If it comes and close in our previous the original iron fly zone, between, if it closes between the original break even point of our iron fly, it is going to be in a profit. If market moves very violently also, we are going to make a good profit. And this zone, if you ask me, if it trades in between this zone also, you are going to make a loss. Yeah, but you have to observe this green this blue line. If the market is trying to move extensively, or it is trying to move very fast in one direction, we don't have to worry about this blue line. 1 or 2 days it is if we are staying at the same place for more than 1 or 2 days, yes, of course we are going to make a loss. But if the market moves violently, we are going to be in a good profit. So that's logic behind the strategy. And this thing also, this zone also can be reduced if we do one more adjustment. That is, like what we did is we we bought 15,200 call and 15,200 put, and simultaneously we bought 15,150 put, right, to make this trade. If the market moves, since we are in synthetic futures, if the market moves on the downside, to protect the futures from any loss, we bought 15,150 put. Say for example, instead of buying 15,200 or buying 15,200 call and selling 15,200 put, had I done it on 15,300, had I done 15,300 call and 15,300 put, and simultaneously if I had bought 15,150 put, maybe this zone will shrink little more. Because what happens is, in 15,200 call, when I bought it, it is expensive because it was I think in the money. It was how much? Maybe around maybe 285 rupees. and the put is around 249, so that becomes a debit transaction. You are going to make payment from your pocket, right? You are going to pay from your pocket. At the same time, the 15,150 call which you bought is also going to go from your pocket. So when you go to, instead of selecting 15,200 strike, had you gone to 15,300, the calls would be cheaper and the puts would be expensive, and since you are buying the call and selling the put, it is going to be a credit transaction. And the 15,150 call at the money put which you are going to buy to protect the synthetic future is you are already going to make pay from your pocket, right? But what will happen in 15,300 is, this is, since it is a credit transaction, you will have some money from the put sold. Once you compensated the 15,300 call which you have bought, there will be some money left and you can use that in 15,100 put which you have bought. So this zone is going to be shrink. Maybe in this transaction 17,000 is a loss. Maybe if you select 15,300 put instead of 15,000, maybe if you select 15,300 strike instead of 15,200 strike, maybe there is a possible that this zone will be shrinking. And some people tell paper trading is possible, real life this real trading this is not possible. I am just telling you an example. You have to develop out of this. You don't we cannot tell everything from A to Z on one video, right? So whenever time is possible, we can try to meditate the strategy and we develop, or we escalate, or we do some other things to manage the position. Now if once you do the adjustment, if the market moves violently in one direction, you are going to make a profit. There is no doubt about that. But once you do the adjustment and if the market stays there for more than 2 or 3 days, then there is going to be a problem. There is going to be a theta decay and you are going to make a loss, right? So in that case, this strategy will not make money. Once you make the adjustment and the market doesn't move, this strategy is going to create a problem. But if the market moves aggressively on the one side after you do the adjustment, this trade is going to give you a profit. There is no doubt about that. On the other hand, if the market reverses after you make the adjustment and closes in between the original iron fly break even point, also you are going to make a profit. But if it goes below the original iron fly break even point, then you are going to make a loss. Yeah. So this is just an idea, or this is just a strategy I thought, and maybe I thought I will share with you. So this is just an example. You just try to play around or try to do things so that you come out of with a more profitable strategy. Maybe you can go to Opstra and test in the month of March, and maybe you can tell how this pans out. So that's it for today. I hope you enjoyed this video. Thanks for watching. Take care. Goodbye.